Hi everybody, today we're going to talk about what the Financial Times refers to as the quote-unquote mother of all bubbles. More specifically, we are going to talk about the valuations in the US, the valuation of growth names particularly, and what it means for expected returns going forward. I've collected 7 different signals that I think indicate that we are probably pretty close to a market top. And so without further ado, let's jump right into it. Alright, hi everybody. Once again, as you can see, I have prepared a little board that is going to structure my video a little bit. As you can see in my banner at the top, I try to be the voice of reason in a world of noise. And I think in the current market environment in particular, there's a lot of noise. Everyone is hyping up certain stocks, certain cryptocurrencies, certain asset classes. And I feel like it's difficult, or particularly difficult right now, to remain a level head. So as I said in the introduction, what I will do is I will take a look at 7 signals that indicate that we are probably approaching the end of a multi-year bull market. However, I will also discuss what it means for you, your investments, and your portfolio going forward. So let's jump right into the first signal. So recently I shared a tweet from IBKR, so Interactive Brokers CEO Thomas Peterffy, that sort of went viral. As you can see, it reached almost 290,000 people. And I basically treated a crazy statistic that Thomas Peterffy, so the CEO, he strictly speaking, he's not the CEO, but he's still actively involved in the day-to-day business. He's the founder, he owns the majority of the company. What he said about the current market environment and the current trading behavior. So that statistic highlighted that almost 70%, or in fact over 70% of the current trading volume on IBKR's platforms are made up by trades in the Magnificent 7, which is quite astonishing considering that, of course, the US market is very concentrated in these names, but these names don't account for 70% of the US market, let alone global markets. But then I think Peterffy actually shared one more interesting data point that I shared in a response below this tweet. And let me just quote what he said during a Goldman Sachs conference during an interview. He said, so over the last 3 months, all margin loans are up 16%, and which is rather, it is a bit very something if you ask me, because I think that equity prices are somewhat overextended. So I guess that's the most important bit already. Peterffy, who has decades of experience in markets, believes that markets are quote unquote overextended, put differently overvalued, put differently, I guess expected returns going forward are going to be a little depressed. Then he proceeded, and I hope that as they come down, they will not come down too far so we can liquidate as it happens, and we will not end up with holding it back off from people who are unable to meet their margin calls. So what he is referring to in the latter half of that response is more the IBKR perspective. He's worried that if the market comes down fast, people will be unable to meet the margin requirements demanded by IBKR. So that's signal number 1. Let's focus on signal number 2. And we can cover this one relatively quickly as well, because I talked about it in depth in one of my recent videos. In fact, I released this video only around 3 weeks ago, so feel free to watch it next. It was about Buffett raising cash, Buffett making a market call, ? I was once again here including some of the more fascinating or more interesting charts from that video that highlight that Warren Buffett is sitting on a record level cash. He's right now sitting on cash that is exceeding $300 billion US. That is in fact more than the current worth, or the worth of Warren Buffett's equity portfolio as of Q2. As you can see, the portfolio value of Berkshire Hathaway, so that would be the stock portfolio, is a little less than 300 billion. At least that's what it was around 3 weeks ago. And I guess just to wrap up this second signal, what you can see here is that, of course, as a result of Buffett raising a lot of cash, the interest income of Berkshire Hathaway, which of course is also a result of higher interest rates, has really surged over the last 2 to 3 years. All right, let's move on to factor number 3. So this is a chart from Charlie Bilello, who regularly, I think on a weekly basis, shares interesting charts on the world of stocks and global markets, global economies, the world of business as well. So it took me a while to figure out what exactly this chart is showing. So let me just explain it to you. Basically, you see that back in December 2023. The S&P 500's target prices of various investment banks, asset managers, financial advisors, big financial institutions are displayed on screen right now. So the average of all of the institutions tracked here was around 4,861. And as of today, let me show you another chart here real quick. As of today, the S&P is sitting at 6,038 points. So based on Bilelo's chart, the S&P was trading at around the 6,000 point mark, which is exceeding the average price target for the S&P for 2024 by 23%, which is quite astonishing. So that's what Bilelo also concludes. He writes, at 6,000 points, the S&P 500 is now 600 points above the highest 2024 year-end price target from Wall Street strategists and over 23% above the average target, which was around 4,800 points. Okay, as you can see, we are moving through all of these signals very quickly. Let's move on to signal number 4. This is a tweet from Tihu Burkhan, and he shared a market indicator that I place a lot of emphasis on when it comes to market indicators. Generally speaking, I don't place much / any emphasis on these broader market indicators. I'm almost exclusively focused on the valuation of individual stocks. But if I ever look at market indicators to get a feeling for where we are in the overall cycle, this would be the one to look at. And this one is basically showing the percentage of US households owning equities. So let me just read to you what Theo was writing. He was writing, there's no doubt this chart should have investors worried. So that's what I would agree with. The aggregate exposure to the market is at a record high. If we look at the numbers, 48% of US households now own equities. And why is this so important? There are studies that show if we go back many decades, the correlation between the percentage of US households owning equities, on the one hand, and the expected future returns is very strong. And the higher the exposure, the lower the future expected returns. So he writes, the aggregate exposure to the market is at a record high. Every man and his dog are long US stocks. And yes, it's reached a level last seen in the first quarter of 2000, just as the tech bubble peaked. It doesn't measure investors' opinions. It doesn't measure Wall Street's predictions. It doesn't measure hedge funds' sentiment. Participants' opinions are important, but not as crucial as their exposure. The chart below analyzes Federal Reserve's data regarding US households' wealth that is parked in equities via direct or indirect ownership. Pretty important data point, if you ask me. So yeah, as I said, I fully agree with him. So that was signal number 4. Moving on to signal number 5. And I'm going to show you a chart in a second that was once again shared by Charlie Bilello, but sort of addressing the same topic is a Financial Times article that I recommend you check out after watching this video. It's titled, The Mother of All Bubbles. The US has never been so overhyped relative to the rest of the world. So that's basically what Theo Burkhan just said as well. Every man and his dogs seems to be owning US equities. And in this article, they write, so basically they just start by highlighting that in terms of political stability, its diplomatic relationships, and maybe also its military capabilities, the US may be in decline, or at least people are not particularly optimistic when it comes to the future development of the US in these areas. However, when it comes to financial markets, as the numbers suggest, we are looking at a different picture. Everyone seems to be willing to own or desperate to own US stocks. So the author writes, but in the investing world, the term American exceptionalism is hotter than ever. And then he continues, united by faith in the strength of US financial markets and their capacity to keep outperforming all other economies, global investors are committing more capital to a single country than ever before in modern history. So what is he saying here? First of all, he's referring to the well-documented long-term outperformance of US markets. And that's right. So if you look at the data, the US stock market is pretty much the best performing stock market in the world on a multi-decade investment horizon. However, if we look at the current valuation of the S&P and other US market indices, will this trend continue? Well, it remains to be seen, and at least you should put a big question mark behind that question. And what he is then also stating is that if you look at the relative valuation of US markets relative to other economies, other stock markets, I should say, other ex-US stock markets, well, we are looking at a record peak. And this is basically the chart that Charlie Bilillo shared. So what this chart shows is basically the forward price to earnings ratio of the S&P, which is sitting at around 22.5 times. And then the MSCI World, which is largely made up of US stocks, ex-US stocks, which is much, much cheaper. We are now looking at, I guess, around 14 times forward earnings, which is more than 50% lower. So that's definitely quite a steep relative, quote unquote, overvaluation, especially if you look at the historical correlation or development of the two metrics. So as you can see, the gap is as wide as it's ever been. What the Financial Times author, and let me just give him credits here real quick. So his name is Rushi Sharma. What he then continues to explain is, and I'm not going to read it to you here, you can pause the video and read that passage yourself, but basically he's highlighting that, of course, there are very good reasons that, or why the US market should trade at a premium compared with the rest of the world. So if you compare the US market, for example, to a German stock market index, obviously the US is growing more quickly. Obviously the US is more business friendly. Obviously the US has much more exposure to the tech sector and has a ton of world-leading companies operating in the tech space. And tech is obviously a broad term, but they have leading advertising companies, leading e-commerce companies, leading semiconductor companies, and so on and so forth, which other markets don't have. However, the big question is what kind of premium is justified and when are investors just paying too much for that above average quality? Which is why the author concludes, and now I'm quoting William Green, who quoted from that very article. And if you don't know William Green, I think he's best known for his book, Richer, Wiser, Happier. He's another well-known value investor, and he seems to be a bit cautious here as well. So he was quoting from the article, quote unquote, America is overowned, overvalued, and overhyped. To agree, never seen before. As with all bubbles, it is hard to know when this one will deflate or what will trigger its decline. And William Green is then asking his readers whether they agree with that assessment or not. And obviously, I would like to know the same from you. Do you think we are looking at an overvalued, overowned, and overhyped US market? Let me know in the comments down below and what you think investors should do going forward. All right, I have two more signals to share with you here. This one here is a tweet from Wasteland Capital, and he was sharing a table from the Bank of America, if I remember correctly. And he writes, historical asset bubble summary from the Bank of America, including the current Max 7 frothiness. Quote unquote, history shows only central banks and melt-ups. Okay, then some of these lasted a very long time, and there's always a trigger event you can observe when it happens. And I guess what's important to note here is, first of all, on the left, you see a couple of different quote unquote bubbles tracked by the Bank of America. And you see the decline on a percentage basis in this column here. In this one, you see for how many years this bubble lasted. And as Wasteland Capital rightly pointed out, you never know when these bubbles will eventually pop. They can continue for a very long time. And if you raise cash too early, this can be quite costly. And I guess what's also worth highlighting here is this column here, which shows the valuation that is not available for all of these bubbles, but the valuation, I guess, at the peak, I'm not entirely sure. And it basically compares the valuation of all of these bubbles to the current valuation of the Magnificent Seven, whose price to earnings ratio, which actually surprises me, I'm not 100% sure how accurate that figure is, but whose valuation ratio on a PE basis is standing at 62 times earnings, which is definitely exceeding the peak price to earnings valuation of some of the prior bubbles. And then finally, let's have a look at signal number 7. This is an article from Owen A. Lamont. Titled Growth is from Mars, Value is from Venus. And what I want to highlight here is actually a tweet that is related to that article from Thomas Carlyle, who is also well known in the value investing community. And he quoted from the article, writing, there's no such thing as the quote-unquote US stock market. Today we have two US stock markets, big growth stocks and everything else. At least that's the conclusion that comes from studying daily return correlations. Big growth is increasingly disconnected from the rest of the market, and the current disconnect is at the 99th percentile relative to US history since 1926. It's as if big growth trades on a different stock market than everything else, such as value and small cap. And let me just show you the chart that he is also referring to here from the article. Basically, what you can see here are the daily correlations of big growth, and the author writes that's basically firms such as Tesla compared to everything else. So that would be big value, quote unquote, value companies like Ford or mid cap and small cap stocks. And as he noted here, something changed in 2020 because the correlation, which was usually around 90%, all of a sudden dropped to below the 50% mark at some point in time. So he writes the most recent trading correlation is actually 58% as of October 2024, which is lower than 99% of previous history. What I plan to cover as well, but I think I will do this in a separate video, is to discuss what Bill Ackman had to say, because he seems to be quite bullish when it comes to the next US administration, the Trump administration, and what it means for the US economy. So I was presenting a couple of bearish arguments here, but you could make the case that with Trump being our next, I shouldn't say our, I'm not a US citizen, being the next US president, maybe this is going to be great. Maybe this is going to create a favorable environment for businesses, which might justify the premium investors have to pay right now. I'm not sure if I would agree with that, but I'll discuss this in another video. Let me maybe wrap it up here by highlighting what Russell Napier had to say. So he gave an interview, and one of the final questions he was asked during the interview was, well, what should you own then, considering where the US stock market as a whole is at right now? And then he replied, he wrote, equities that won't be liquidated because they are not overly represented in the portfolios of institutional investors. The unloved, the underowned assets, mid and small caps, as well as value stocks. Also, I'd look out for equities that benefit from the global capex boom. Japan offers many of them. The typical fund manager today has 40% in bonds and 60% blah, 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 blah. In order to do well in the big structural change that I see coming, you have to be radical in your portfolio. Counter-positioned, I guess, would be the keyword here. No bonds, no S&P 500. That's quite a statement to make. Buy equities that no one wants today and own much more gold. So personally, I'm super skeptical to investors recommending gold as an asset class, because I think that's more of a short-term, maybe mid-term trading strategy, because long-term, over the very long-term, gold is not going to be a well-performing asset class simply because it's non-productive in nature. However, I guess he's onto something with the rest of the comments he is making here. Generally speaking, if you want to do well in the world of investing, you can't own what everyone loves. So I agree with that take. I wouldn't say that you can't own members of the S&P 500, but as Thomas Carlyle highlighted, or the article he was referencing, I guess you have to make a distinction when it comes to the US stock market, the big tech growth names on the one hand, and literally everything else on the other hand. So if you own individual companies that are trading at attractive valuations, I think you can still do well if those companies are members of the S&P 500. Okay, let's keep it short here. I'll see you in one of my next videos, and I would love to know what you think about everything I said in this video. Take care.